Save it for the. I assume that's one of your points, isn't it, Jay?
Well, no, but my point is I don't know the answer, and I don't know if anybody knows the answer, and I don't want to have a conversation where we're talking about economics and we're all like, I don't understand how this works.
Because the market's backwards.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 34 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and the gang's back together, boys. We took off a week, and we're all back, ready to go. Took us a little while to get going because some technical issues. Not AJ's fault. I'm not going to blame it on him, but it was AJ's fault again.
Thank you. Definitely Mauricio. I had mine solved before he did.
How's it going, AJ? We missed you last week.
Yeah. Little bit of flight problems, and that's never fun. But I made it.
And by flight problems, what he means is he's really bad at time zones. He didn't realize he was changing. He was flying to like 2 states over and was going forward in time or back in time.
And a 2-hour delay and connections. There's all these weird things you got to do.
This is what happens when you decide to not take your own private plane and go commercial. That's really at the end of the day what happened.
He didn't have his pilot explaining to him, okay, when we land, it's actually going to be this time back home.
Listen, these things are complicated, okay?
So you're back in your studio. Does that mean you're back to the fountain Coke?
Yes.
All right, man. Jay, how's it going over there?
I am doing well. I'm bummed. I am bummed. Since we started this show last June, we missed July 4th week on purpose. We missed Christmas week on purpose. And last week was the first week we missed that wasn't a holiday. And I actually had people reach out to me. For all the people that reached out to me and said, why don't you have a show today? I would think our listener audience should be a whole lot bigger. Because I had like 100 people reach out to me and say, why is there no show this week?
We're like those cult movies. We have a cult following, I guess. It's we're not that popular, but when the people love us, they love us.
So we hit the board in Estonia this week. So apparently we hit the top 200 in Estonia this week on Apple Podcasts. So thank you to all our Estonia listeners.
Yeah, thanks Estonia. Get us there. Tell your friends. Jay, what are you drinking today?
I am doing Blue Moon Light Sky Citrus Wheat, leftover from a football game. I
was going to say, is that a tailgate leftover? Did you pull that out of the back of the truck?
That was a tailgate leftover from a month or two ago.
Wow, scraping the barrel. You must have been tough to get to Costco this week.
My wife's not drinking tonight, so I'm not opening a bottle of wine.
There you go. Mauricio, how's it going, man?
Dude, I am pumped. I just found out my book. I know, Jay, you've written 17 books. My first book will be published in a couple of weeks. I'm pretty pumped about that. Yeah.
Oh, you can talk about it now? You throw out a name yet, or
I'm not gonna plug the fact that the book is called Legal Strategies for Everyone. I'm not gonna plug it. I'll leave that till the end. But yeah, I think first week of March. And I am slumming it today. This is the kind of sacrifice that I make for this podcast. So I am drinking a butter Chardonnay, which is pretty buttery and over oaked. And it's because it's the one that we used for cooking on Sunday when we made a little cheese fondue, put a little wine in there. And we celebrated Valentine's Day on a Super Bowl Sunday. So that was fun.
Why?
That's how we roll.
Just cause?
No, like tomorrow, when this podcast gets released, is really Valentine's Day, but we do a family Valentine's and the kids got dance and stuff. So there's no time to do it on real Valentine. I leave for Canada the following day. I got this podcast the day before, so we decided to do it Sunday.
We're doing ours Friday.
There you go. See, I'm not the only one. Guys, if you are listening to this, drop a comment if you don't celebrate Valentine's where the powers that be tell you. You do your own thing.
I mean, it makes more sense to do it on Friday because then you get all the half off candy. That's probably why Jay does it over there.
I just do what my wife tells me.
Well, your wife is pretty frugal, so I appreciate that about her. We missed last week, and it's okay because I almost didn't even have a voice because I had these real estate girls, like women in real estate. There's not many of them, but I had 2 of them come and visit us. So I had Serena and Ashley Kerr come and visit us. And
wait, how come Ashley gets the last name but Serena doesn't?
Well, because Ashley is the same name as my Ashley, so it's like specifying. It's like, you know, on the back of sports jerseys, they only specify if there's two of them.
Got it.
That was a great sidetrack. So these women in real estate, like they're like alone. They're almost like dogs. I know my wife's going to love this analogy. Yeah, they're like dogs.
Wait. Did you just say that the women in real estate are just like dogs? Is that what you just
exactly. So clip that part without
And
my
we're
explanation.
canceled.
Wow.
No. Stop. Let him keep digging. Keep going.
So let me finish off this analogy.
Let me
So
go.
like a dog, right?
Let me go get the shovel. I'll be right back.
So like a dog, right? Like you love hanging out with a dog, right? Like dogs are amazing. You hanging out with they're easy.
A dog or one of those bitches.
They're
a
great.
bitch thing or a dog? Like which one is this?
You put two dogs. You put two dogs together, and it's almost better, right? Like they occupy each other. They're fun, but you put them in a pack, and it's uncontrollable. Like you get three or more of them together, and you just can't control them. They're always doing stuff. They're always getting you to do shit. And I partied way too hard. I lost my voice. I couldn't function for a couple of days. So
since this is our last episode we'll ever be recording now, just want all our listeners to know that we love you guys. It's been a great run.
Well, and I know Ashley listens to this, and I'm going to see her later.
I want to make sure I understand the analogy. So usually you have one dog, which is your wife. Is that what you're saying?
Love
You have
it.
usually one dog,
right.
and usually you can control your dog. You know exactly how to do it.
I didn't say
and
control.
you got it
I
under
said
control.
it's fun and it's easy.
But when the other bitches show up, right? The other dogs, the female dogs show up. It's like everything goes to hell in a handbasket. And you have no control over all your bitches. Is that what you're saying?
No, there was a step in there. Two dogs is easy too, right? When you have two dogs, they occupy each other. They hang out with each other, and they're fun. But once you get a pack of them, you can't it's mayhem.
Remember, everyone, this is drunk real estate, so please forgive.
Well, there might be a reason. So
I can't wait for Ashley's comment. I'm sure that'll be the first comment down there on the YouTube channel.
Okay, let's jump into our first segment on why cancel culture is bad and nobody should be canceling
When
anybody.
no one should participate in cancel culture.
you can clip me. You can clip me just the way like Kamala Harris got clipped. So like every single news headline was like Kamala Harris says she's ready to step in for Joe Biden, and you're like, what? And then you actually read the article, and someone flat out asked her, "Are you actually ready to step in?" And she said, "Yeah, I'm ready to step in." But that's all. So you can just take that clip, and everyone will run with it.
Okay, so now we're talking politics. Sweet.
Okay, let me talk about my drink first. So the reason I was getting into that is Serena came and visited, and she brought me this this barrel Dovetail, and it is 123 proof. So if you think I'm putting my foot in my mouth now, just wait till later on in the episode.
Is that that's 61% alcohol?
61.72% alcohol.
Man, AJ, what do you think? What was the last time you had 61.75% alcohol?
How much is in Diet Coke?
I want to know what the other 39% is.
Just corn, probably. Okay. Should we get into this?
Sure.
We might have to pull that part and put it as the intro.
Who's up first?
I'll put Jay.
I'm
I'll
not.
put Jay first. Let's talk about. Let's get an economic update in here, I guess.
Wait. Let's get Jay first, and let's have him talk economics. Wow, there's a shocker.
Well, if we leave it last, everyone's going to tune out. We've been through this, Mauricio. Jeez. All right. The CPI print came out this morning, and while inflation came down from the previous month, it actually came down less than expected. So apparently that was enough for some people to panic and the market to take a hit. It seems like after that big exhale last month, people are back to being on edge about every economic release. So Jay, what should we actually be paying attention to?
First of all, before Jay gets in there, I got a compliment. That was a beautiful teleprompter read from the new teleprompter. I thought it was fantastic. I thought it was very natural.
Thank you. Was it good, or are you just giving me shit?
Yeah, I don't know if you guys picked that up, but I thought it was a very professional teleprompter read. Go ahead, Jay. Sorry.
I literally didn't hear a word you said. I do know what my topic is, so I'm good to go, but I wasn't listening to you. I was sitting here thinking that I don't care if we have 0 listeners for this show for the rest of history. This is my favorite thing I do all week.
Yeah. This is hands down going to be the best episode we've ever done.
Well, it'll be the most highly rated because it'll like all the people will be fighting in the comments and shitting on me. So it'll be great.
Oh, I love it.
Okay. I think you said something blah, 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 economy, blah, 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 CPI, inflation, blah, blah, blah. Okay. So
Jay Scott, blah, blah, blah.
Yeah. So, okay. let's start with the economy, but I want, there's other stuff more important, but real quick. So yeah, inflation came out today. They were expecting 0.2 month over month, which translates to like 2.5%. Annual came in at 0.3, which is closer to 3.5%. Everybody's freaking out that inflation's going up again. The reality is that, yeah, inflation went up month over month by 0.1%, which is like 1% higher per year. But the reality is it's not that big of a deal. So on an annual basis, inflation's actually down from last year. So we dropped from 3.4 last month to now 3.1 annualized. So things are actually still trending in the right direction, even though this month was a little worse than last month. But here's the big thing. If you actually dig into the data, there was one part of the data where we saw inflation kind of take hold last month more than other areas, and that was shelter. So basically, shelters consists of a few things. It consists of rents, so how much people are paying for rent. It consists of what owners say they think their house should rent for. And then there's this other little piece of it where we measure shelter away from home. And that's basically the cost of hotels and motels. And last month, we saw the cost of hotels and motels go up 1.8% for the month, which equates to about 20% year over year. So the big thing that happened last month that contributed to CPI inflation going up, it's not the only thing, but the big thing was hotels and motels for some reason went up in price a whole bunch. Rent went up a little bit, 0.4%. Owner equivalent rent went up 0.6%, which is about where it's been over the last year. So shelter is still high, and that's what contributed to this high reading today or for last month. But here's the thing: the Feds recognize this. We've talked about this on this show. There's a lot of housing coming online in the next year, and as that housing comes online, we're going to see a muting of rents. We're going to see rents start to slow down in growth. We're going to start to see housing in general slow down even more than it already is, and we're going to start to see that reflected in the numbers. So I expect that this is kind of a one-time issue with shelter kind of outpacing everything else on CPI. And I suspect that within the next month or two, shelter is going to start to come down and our numbers are going to be right back in line with where they've been for the last 6 months.
Can we clip that and let's replay that the next time the CPA numbers come out? I mean, look, I think it is a little bit bigger. I know it's not, the actual numbers aren't that big of a deal, although, 0.1 is, 1.2 over a period of year, but I think the trend's important. We talked about the trend and expectations, and people were expecting the trend to continue to go down. And I think everybody just thinks, oh, we've got this inflation thing under control. And so let's, it's going down, down, down. And so this reversal, even though it's only 1 month, I get that, but it will be, I don't know what's going to happen next month. It will be interesting to see next month, whether that is a second month where inflation ticks up again, or if it just, like you said, Jay, it's a reversal. But I think trends do matter. And I think, especially in this, we can talk about what happened in the markets today, but everybody's pursuing the markets with an expectation that something's going to happen. So anytime that changes, I think it is a big deal. And I'm kind of curious to see what's going to happen next month, because if next month is another one, now it starts to see a trend, which, by the way, is the way it works. Inflation doesn't go up in a straight line. Deflation doesn't happen in a straight line. It's going to go up and down and up and down. I fully expect, and I think we have I forgot what the bet is, Jay, but I fully expect inflation will start to creep up again over this next decade. And the question is it going to reach 9% again, or is it not? But the idea that the inflation goes from 2% to 9% and then goes back to 2% and we're done, I think that's a little naive.
I mean, the other thing to keep in mind is there's only one significant figure here. So we're talking about 0.1. And so 0.1 could mean 0.5. Or it could mean close to 1.5. And there's a big difference there. And so, but we round to 1 if we're above 1 or below 1. And I could probably dig into the data and figure out if 0.1 higher than last month really means last month could have been almost 0.5% higher than what it was. And this one could be almost 0.5% lower than what it was. And the rounding makes it look like 0.1 when in reality they're essentially the same number. Or it could be the opposite. It could actually be closer to 1.5% or 2% if the rounding went the other way. And again, I haven't looked into the data, but I think, again, I don't see a trend here yet, but we'll come back next month. And if there's a trend, we can talk
about. The overall trend is down. Like that was the crazy thing to me, is that, yes, it was higher than what was projected, but like we still went 3.4 down to 3.1. And so like, everyone's still freaked out about it. I just feel like everyone's walking on eggshells right now, like just waiting for any bad news to be like, oh God, we were wrong. Like let's panic again.
But the month over month though, I think was expected to be 0.2 and it went to 0.3. Is that right?
Yeah. Yeah. And the reason we went from 3.4 to 3.1 for the annual number is that this reading, January 2024, replaces January of 2023, which was a high number. So even the relatively high 0.3 this month is lower than the number it replaced. I think it was 0.4, 0.5 last January. So it's relatively high for a monthly.
And we've had a bunch of 0.2s in a row too. So like, even if you annualize and you take your pick, the 3 month, the 4 month, the 6 month, even if you analyze that, the numbers are looking pretty good.
Yeah.
But let's talk about the market reaction, because I know, AJ, we were talking about it beforehand, but I mean, it sounds like, you know, you would expect some things to go higher and other things to go lower, but it sounds like everything sold off. The equity sold off, the bond sold off, gold sold off. Like, where are people putting their money? Because I know there's uncertainty, but
money market bank accounts, you can get 5.25% right now. So anytime you panic, it's pretty easy where you put it. It used to be you panic, you put it in gold, right? Oh, gold's a safe haven. Well, now you can get 5% to just do nothing. So why not doing it?
Yeah, and it's one day, and so it's very possible people are cashing out, and the money just hasn't been redeployed. And so if I sell a bunch of stock, it's going to take time for that trade to settle, and I may not redeploy that money into bonds until the next day or 3 days later. So it is weird. And we were talking about this before the show. I think it is weird that the bond market sold off and the stocks went down and gold went down. So it's a reasonable question. I'll be curious to see in the next couple of days if any of those have a more significant move in the other direction.
how did Bitcoin do? Maybe everybody put their money in Bitcoin. No, it was also down for the same thing, 1.25. Yeah.
Here's the problem. The problem is that the overall inflation number needs to be significantly down. It doesn't sound like a lot, but that's because we were talking about uncontrollable, outrageous at 9%. We're not close to where the Fed wants to see it. And the Fed will not make actions until they get consistently at target or below. So if you're at 4%, that's double what they want. We're at 3.1 for this one time. We have a floor though above 3%. Their target is 2% or below.
But it's been going down basically every month.
Well, it hasn't gone down below 2. Even if it goes down though, that doesn't matter. We haven't dropped below 3.
We know there's a lag effect from what the Fed does. And we know that if there's a lag effect, then they have to stop before they hit the bottom. So at some point they have to stop, even though we haven't hit 2%. And so it's just, when is that point?
Yeah, but that's taking this in isolation. You need jobs. So we have high job markets. We still have income going up. We still have a tight housing market. There's no other things that are going.
Why do those things matter though? Like, I guess I always didn't understand, like, why are we focusing on jobs have to jobs have to do worse for us to hit our inflation target?
Because that drives inflation. People have money, they spend. If people don't, if you doubled the unemployment rate, inflation would start to lower. It's a natural thing if you don't have money.
Well, it's one factor though. But if we got to 2% in inflation and we still had jobs at 4% unemployment, like, wouldn't we win? Wouldn't that be considered a win?
Well, we all say we know, but we don't. It hasn't gotten there. It's never broke 3%. And so that's still significantly higher. That's a third higher than they're trying to get. So everybody's waiting for this action, but they do need to see it. We're not seeing it in the other markets. Stock markets sit at an all-time high. I mean, we've got everything is still high. So I think that's the reaction. People are going, we're expecting this, and we're not seeing it anywhere now. And the Fed now, because of it, they need it to go down 30% more before they're going to even make an action.
If we keep seeing inflation come down, then this issue or this like concept of real rates, keep going up. So the Fed doesn't have to raise if inflation comes down, right? So if this concept of real rates that, okay, if the Fed's at 5.25 and inflation's at 3.25, then the real rate is at 2%. Well, if inflation keeps coming down, then that real rate gets more and more restrictive every time. So like at some point they have to say, okay, we're sufficiently restrictive and we got to keep coming down with the pace of inflation. And I think we're already there. Like, stay restrictive, but let's keep it. Let's not get more and more and more restrictive, because as inflation comes down, we're still getting more and more restrictive. And to me, that's when we're going to have issues.
Yeah, I mean, just the first analogy that comes to mind here is it's kind of like saying that inflation's not below 3 and that's a problem. It's kind of like if somebody punched me in the nose 2 years ago and broke my nose, and yeah, my face was all bruised and bloodied and bloated for a year, and then it started to heal, and now we're a year later and I'm still a little bruised. You can't say that, okay, we're still having problems because my face is still bruised. I mean, it's getting better. It takes time. And we got punched in the face with inflation a couple of years ago at 9%. And the fact is we're still bruised. And there's still
that was a David Green analogy right there. That was great.
I was going to go with, what in the world is that the analogy you're going with?
And this is coming from somebody. I bet you Jay's never been punched in the face in his life, so he's just hypothecating there.
Okay, we'll talk about that. That'll be our game later.
Says the hockey player.
Yeah, but the problem is, if you look at the past, the Fed has done the wrong thing, meaning when inflation went down, they eased too soon. They've never not, like, that's been the problem. And so that's what they're afraid of. And when you have such tight markets, any movement from them on easing will inflate the market very quickly. So when that's the problem, is it needs to be down, consistently down, under control, so they can say we can ease without it erupting like it did when we eased too soon in the past.
But I feel like, what was that? The one time you talk about the 70s, like every other time the Fed's been late on it. Every single time they've been late to raise and late to cut. So every single time. So I feel like
it's better to be late, though, in their minds than it is to be early, because inflation, when it shoots up like that, that's a much bigger problem than we dip down into a recession and then we lower it a little tail and then get out of it.
I don't know. I would say deflation or even stagflation, those are pretty big issues that they might not be able to fix that easily.
It's only happened twice. The deflation's only happened twice in the market. And generally speaking, though, it wasn't caused by that. It definitely wasn't caused by that.
Well, the 70s only happened once. So here we go.
But it was caused by that. That's the point.
But I think where I think AJ has a good point is that, earlier on, or right when there was that pivot, the market was expecting, I think it was 7 rate cuts in 2024. And they quickly backtracked on that because the Fed came out and kind of backtracked and said, hey, wait, we're not saying we're going to cut that much. We're pausing, we're data dependent, whatever. I think there's, again, the trend and the expectations is going to have this thing where, I don't know what the current, I think it was down to like 5 rate cuts. There's a good chance that rate cut expectations are going to start coming down over the next couple months because of this inflation. Because if inflation starts easing up again, to my point earlier, if the trend is reversing a little bit and maybe next month, again, CPI goes up, which wouldn't be crazy. Now the odds of the Fed cutting their rates 7 times, 5 times, 3 times just starts going down. And now suddenly
that's what matters.
Yeah.
It doesn't matter if we think it's right or not. Who cares about that? It matters what the Fed will do. And so when we see this, we know the Fed's going to go, the market's tight. There's money everywhere. Real estate prices are high. Everybody's got jobs. Everybody's got money. And now all of a sudden inflation's not coming down. So then the market goes, all right, the Fed's not going to start easing. And so that's what matters.
Let me jump in here because we're debating over this literally maximum of 0.1% difference in expectation on one data point. There's other data points. So we haven't had much of an general economic discussion for a couple of weeks. Let's talk about some other data points that we've seen in the last couple of weeks. Number one.
Are we talking about some cherry pick data points you're going to come up with, or are these comprehensive?
You're welcome to present your own, Mauricio. So let's start with GDP. So we saw GDP came out a couple of weeks ago, and it wasn't the real GDP number. It was kind of an advanced estimate, what they call it, which is basically there are 3 versions of GDP, each one successively better, more information. This is the first pass for Q4, and we're up 3.3%. So it's a deceleration because we were at 4.9% in Q3. So things are slowing down, but there's still significant growth there. So that's one data point that the economy is still chugging along. People are still spending money. Another one, and this one's actually going the opposite direction. And I think we were all waiting to see this one, and we're finally maybe starting to see it. But in December, consumer credit. So in November, Americans took out over $23 billion in additional credit. In December, that number was only 1.5 billion. So literally, like overnight, the spigot for credit demand kind of shut off. Now, was this a 1 month event and things will get back on track? Because I mean, happened in August also. People stopped taking out credit. It actually was negative in August and then picked up again. So maybe it's just a blip on the radar, but this could be the start of a trend where people are running out of credit. And so I think that's something to keep an eye on as well.
Well, and you're right, because when you look at 2023, going out of 2023, the last 2 quarter GDP growth were substantially higher than obviously anything in 2022. You're talking about like a 3% GDP growth in both of those quarters. And so when you're looking at it, the economy is cruising. I mean, for the American economy to see quarters like 3.5, 3.1, 3.3, and it chugging at this level, this heated consistently, that's like, what is, if the Fed all of a sudden eases tightening, what's going to happen? That's what they're looking at. That's what they're worried about. Job growth blew past expectations. So the economy is moving.
Yeah, and it has been. I mean, I think we're just finally accepting that this isn't just like a blip and it's just everything's going to come crashing down. I mean, anybody that was listening to us last summer and in the fall knows that we all predicted, every single one of us predicted that there was going to be a recession either by now or very shortly from now. And there's no indication that's going to happen anytime soon.
And the Fed's not going to get real about easing if the economy is moving like this, because they don't need to. There's no reason to. And they can't, because it'll overheat. So the Fed is not going to go ease when you have the U.S. economy hitting 3 to 4% GDP growth every quarter. It's not going to happen.
Well, I always had the question, like, what's the comfortable level of GDP growth? Because GDP just seems that like wild swings. Like, we know inflation, we know, right? We want to hit 2%. We want to get close to 2%. That's our number. But like this GDP, like, I feel like it's all just people gauge it based off of this was the expectation. Was it below the expectation? Was it higher than expectation on whether or not like the GDP was a good print? But like, what's the range that you would say that like everyone's comfortable with? Like, oh, that was just a normal, healthy GDP and not an overheated or a problem.
2.5% is the historic average. And it pretty much runs in line with inflation. Right.
But would you say like, so 3.5, is that like overheated? Or like 1.5, is that overheated? Do we get like a 1% like range there? Or like, what's the, like, I just feel like people use the word like, oh, it's overheated, but then it's like, 3.3, is that overheated? Like, is that crazy? Or is that just like, pretty close to what we're looking for?
Well, I think it's relative to what's expected. And if you think that things should be slowing down, anything over the average is going to be a little bit alarming. And again, we're coming off of Q3 of a 4.9% number, which was just absolutely ludicrous. And so it's saying that things are a lot hotter, a lot better in some respects than what we're all expecting.
Consumer spending's up. Consumer spending grew by 3%. So people they can continue to consume. It's like the economy.
Where are they getting that money from?
They're getting the money from their assets. So their houses are going up in value and the stock market's going up in value.
Well, you can't, just because your house goes up in value, that doesn't give you more purchasing. You can't just go out and buy more stuff from your house going up.
Well, a lot of people figure I can borrow more on a credit card if my house has gone up because, hey, I can cover it if I need to, right?
Investments grew at 2%. So people are investing more.
Yeah. Here's another thing. We're talking about one side of the equation, consumers, and consumers are obviously spending a lot of money, but a good leading indicator of where the economy is going is businesses and how they're spending money and what they think they're going to be doing in the coming weeks and months. And so last week we saw wholesale inventory data. So basically an indication of companies that manufacture buying materials, buying inventories for resale. And that number was hotter than expected, which indicates that businesses think that people are going to keep spending and they're building up inventories because they expect that sales are going to increase over the next couple months. So on both sides of the equation, consumers and businesses, there's a lot of optimism right now.
Yeah. And your Fed's not going to go pour gas on that fire.
No, they're not.
And that's why you see the shock when we don't see those trends, because investors are like, oh, we're not going to get lower interest rates anymore.
Yeah, I think the likelihood that we see a rate cut in March, which was, and I haven't looked to see what the market's pricing in, but the likelihood I think of that at this point, I mean, what's that, 5 weeks away?
And I think even May's down to 60%, I think even now. So like it's almost pushing back to what's the one after May, June, I think. So it's
so how are we going to get 7 rate cuts in 2024?
We're not. I mean, unless they're cutting through the election, which we already talked about, they won't. They'll probably pause July, so we might see 2 before the election, and then but you know, there's been crazier things. If something happens, maybe they drop it a full percentage or something.
Well, and doesn't like Biden doesn't he bow out more like in the summer? Is that when that happens? When does Biden have to bow out?
I think he's going to take off in the summer. I think that's right.
The convention. I thought the convention is when they have to, where he just disappears.
That's their last chance.
All right. Well, we said we weren't going to talk pocket politics. That's we'll save that for next week. So
who said that?
You did.
Oh, okay. Never mind.
Yeah, it was you, Jay.
Never mind then.
Yeah, AJ and I were ready to go. I even queued it up a little bit. All right, let's move on. Hey, Mauricio, can I do AJ next without you getting bum hurt? Because you already made a comment.
I got to turn the air down. I'm getting cold. So talk to AJ. I'm going to go take a nap, and I'll be back in 25 minutes.
Thanks for participating, Mauricio.
All right, let's move on. So in the words of Kevin Kistner, this ain't no hobby. I don't know if you watch the Barstool.
Is he the guy that won the Super Bowl?
Jesus, okay. And I took you to a football game too, Jay. I took you to a football game. We're often asked about the difference between single family and larger stuff, and our response is always that once you get to commercial real estate, you're really buying businesses and not real estate. Well, AJ takes it a step further from that, where not only does he buy units, he also buys businesses that own those units. So AJ, why don't you talk about how real estate becomes more of a business?
Yeah, I think, you know, when we think about real estate, there's 2 sides to it. You have the business of real estate, and then you have like real estate as an investment. And there's a lot of people that invest in real estate. Then there's other people that make it into not like an investment passive, I'm leaving my job, but the actual business of doing it. And these are 2 very different things, right? They are not the same thing. So when you look and you have it broken down into it, you have businesses that they actually find, they fund, they buy, they transact, right? They're in the business of doing deals, creating deals, packaging deals, and that's their full-time gig and thing. But they need to actually be doing the thing to make money, not just pure passive income and investment. So they build out a team and they build out a company that's supposed to work and do that. And I think a lot of people get a little confused on, you know, a real estate company versus owning or investing in real estate. And they're not really the same thing. A lot of people may look at it and even call it, oh, well, one's like real estate private equity, but you don't obviously need to be taking personal capital private capital to do it. You can build out a company that's what they do. You have acquisitions, right? You have all of those different types of components, but that is generated from other types of business activities. And those businesses contract and expand predicated on the real estate market and transactions and how they're being done. So what we've seen in the last year is the business of real estate has really contracted a lot. Like we've seen major layoffs in everything from acquisitions to debt departments to all of these firms that when markets were hot, they were doing lots of deals. They were hiring on back end teams. You had everything from your underwriters, you had your asset managers, you had your acquisitions, your callers, your closers, you had your legal departments, you had all of these things that were humming because they were doing deals. And they get money on fees, equity, right? Everything else. Well, when the deal market, due to high interest rates, slowed down, the business of real estate got hit hard, even if the real estate didn't necessarily get hit, meaning the portfolio may still be cash flowing, everything else, but that back end, that business arm of it, we saw a lot of people really get hit. And a lot of people don't understand, well, I don't get it. The real estate's doing fine, right? Well, just because the real estate's doing fine doesn't mean they're doing business. That business has to move. They have to transact to get paid. And we've seen a lot of that in the last year. So there's a big difference when even looking at syndicating versus these different branches and arms of the real estate business, like a brokerage firm or realtors, right? They're in the business of real estate. And we've seen big
Or syndication firms.
Yeah. Yeah. So we've seen a lot, right? It's been hard. It's been a hard year for firms. And a lot of people have been laid off. And it's been pretty upending for a lot of people in the real estate world in 2023 that we're doing that. And I think moving into 2024, it's not going to slow down. I think a lot of these firms are going to struggle.
Yeah, I think one of the things that we're starting to recognize, this year, after the last year and a half, is that we've always thought about the worst thing that can happen in real estate is the values drop. And certainly we all agree values dropping for investors is a bad thing. And we've never thought about that there's another situation in real estate that can happen that can tremendously affect us as well. And that's transaction volume dropping, the number of sales, the number of transactions falling as well, because you can have number of sales fall without values falling. We're seeing that in the single family space. I mean, single families values are at the highest point in history, but inventory is super low, transaction volume is destroyed, and yet it's destroying the single family business. Realtors are getting crushed. Construction people are getting crushed. Mom and pop investors are getting crushed. Big companies like Blackstone are getting crushed because values are dropping, but because transaction volume is dropping.
Well, also we've had this trend too the last few years where like the payout structures now with these major prefs, that like all these firms, the only way they're making money is by doing transactions, right? You have transaction fees. You have, if you're integrated into like all the different portions of the transactions, you get a little bit of fee here, you a little get fee there, and that allows you to pay your acquisitions people, allows you to pay all these different people. And the problem is that if we have like a 8% pref on a property, yes, that property's cash flowing, but we're not making any money. Like we have equity, but we're not having any cash flow coming in to keep our lights on in operations. So once all of a sudden those transactions go to zero, then all of a sudden you're like, shit, how do I pay my acquisitions, my lead acquisitions person when there's no acquisitions? Like I don't have an acquisition fee. And people question these acquisition fees like, oh, you're taking, 2% acquisition fee. Like, what is that doing? Well, I got to pay people, right? Like I have an asset manager, I have a acquisitions manager, I have, all these people that I have to pay along the way. And if I don't get those fees, what do? I just got to, pay to the coffers.
I don't even take them seriously because I'm like, oh, you'll be gone. You're living on an upcycled market and where you can just make money because you're flipping deals and then you get this equity payout. And I'm like, but you don't have an actual functioning business. And that's really bad for investors. Why? Because if the only way they get paid is when markets go up, your operating partner that's in business to do this thing for you, when it stops, they're laying off employees. Now, they can't run a good business anymore. The way that they can take care of the investors and the assets starts to deteriorate massively. And a lot of investors don't think that through. They actually think, oh, well, it's great because all they're getting is equity and that's fine. But then all of a sudden, well, we don't have communications. Why? Well, their investor relation person's gone. Well, we're not getting time reports. Who's watching over the asset? Who's doing it? They can't afford to pay. Or
even worse, AJ, even worse. Like somebody who, let's say you haven't done a deal in a year. Like, what are you going to do if you need deals to transact? You're going to do one of two things. You're either going to sell a deal when you shouldn't because you need to get the money out of it, or you're going to buy a deal that you shouldn't be buying and you're going to just fudge the numbers a little bit so that you can get those transaction fees, which that's even worse than what you're talking about.
If they don't have fees, they are not in line with investors. I firmly believe this. If you do not have fees, that means your money is you are incentivized on transactions, not returns. Because of what you just said, you have to sell or you have to buy. And we see this all the time. Guys that have big firms, they have to get it. They don't have enough fees to adequately cover their staff. They're going to buy. Whether it's a good deal or not, it doesn't matter, because if they don't, they can't survive. And so all of a sudden investors are getting in on deals that they would have never bought at any other time. But now they have to even survive, whether it's a good deal or not. And it's really important that LPs and investors understand the difference between the business of real estate and the asset. And it's great if there's no fees when times are going up and they can just rotate through the money because nobody really notices it. But all of a sudden, when they can't churn deals, their business model literally evaporates and the investor's the one that gets caught.
Yeah. And people always think that the fees are where, operators get rich, or that's how you keep the lights on. That 2% asset management fee is to just get the office going, put the lights on, the acquisition fees. I mean,
we have an asset manager. How do we pay our asset manager? We need money to pay them.
Yeah. Well, to your point, I think to your point, it's a good one. Investor relations. It might be the first place they're going to cut because it's like, that's, how valuable is investor relations? And it's like, hey, then they start complaining. Hey, the response time is lower and all that stuff. And, transaction volume. I mean, we're in that business too. Like we're a business. We're, obviously we're a syndication business. We run a syndication law firm, and on the syndication side, transaction volume's down about 62%. We kind of did a deep dive on the SEC filings, and transaction volume and syndications is 62%. So I think overall, that's a pretty accurate 60 to 65%. Drop in transaction volume. But yeah, like I'm curious to see how many of our audience members are in the acquisitions, like they're actually acquisitions managers or director of acquisitions or VP of acquisitions. And how tough has that been? Because if transaction volume is down 62%, what are you guys doing? Like you're probably getting laid off because it's like, why am I paying my acquisitions guy $100,000 a year or $200,000 a year? I got no transactions to do.
Yeah. I haven't seen this good of resumes in a decade, Mauricio. The amount of resumes I have sitting on my desk from people that are absolute rock stars are shocking.
Can you pass them on to us? We're hiring, AJ.
No, I can't.
I want to go back to something Kyle said earlier, because this is something that's really bothered me. I know transaction volume is down, and Mauricio, let's say your 62% number is accurate. Certainly, I mean, it could be more than that. I'd probably believe it. But I think that what I'm seeing is that it's a lot of the smaller players that are going from 1 or 2 or 3 deals a year to 0 or 1 deals a year. I mean, we've done 2 deals in the last 2 years. So we're certainly in that category. We're pretty conservative. But then I see all of these other groups, these big multifamily groups that are doing as many, if not more deals than they were doing before the market started to crash. And we underwrite. I mean, I see these deals every day. Kyle's our lead underwriter, so I know he sees these deals every day. And we know that most of these deals are not penciling. And in order for us to do 4 or 5 or 6 deals a year, we'd probably have to be looking at literally thousands. And there just aren't thousands of deals out there to look at. And so my concern is that there are a lot of groups out there that are worried about keeping the lights on. They're not selling. I mean, when you sell a deal, you make a lot of money. You live for a couple of years. But if you're not selling any deals in a bad market, you need to keep the lights on. And as Kyle pointed out, one way to do that is you do a marginal or a bad deal to collect the fees. And I suspect, not because I think people are necessarily bad operators, but just based on the volume of deals that I see some groups doing, there's just no way you can convince me that they're actually finding that many good deals.
And you could justify it pretty easily right now, because you could say, and you could look at the macro level and you could say, hey, look, apartments, in the case of what Jay's talking about, apartments are down 25% right now. So it doesn't matter what I buy. If I buy right now, as long as I hold it for 3, 4, 5 years, whenever, then eventually it's going to come back up and we're going to be fine. So
interest rates are going to come down, so the sales price is going to go up. So that means we actually have a good deal.
Right. So it's easy
and cap rates are going to come down too.
Exactly. Cap rates are going to compress, I'm sure. So it means we have a good deal.
I mean, but we can laugh about it, but like I laughed about it before and it worked for all these people, right? Like they bought these shitty deals,
exactly.
and then I'm like, oh, look at this idiot paying this much for this property. And then all of a sudden in 2 years, cap rates went down a full percentage point and they were selling and they were, driving around in their Ferraris. And I'm like, who's the idiot now? Like,
Well, also judging how many have imploded in the last 6 months, Kyle.
Yeah, I mean, it's fun for me because I'm in like a unique situation because we obviously do a lot of these. We do probably 100 to 150 of these every year, and so I literally have clients who are in both camps, right? So I have clients who are in the camp like you guys are like, hey, I can't find anything, nothing pencils out. I'm doing maybe a deal a year, maybe a deal every 2 years. There's nothing out there, nothing pencils, right? And then I have other clients who are like doing 6, 7, 8, like a deal a month. They're just going crazy. And it's like, I'm in the, like, I don't have a dog in the fight. It's like everybody has their own thing, but it's interesting from my perspective to see those two completely different angles, opinions, approaches, philosophies. And they couldn't be further apart than you could figure out. Like it's pretty interesting from my position. Again, I don't get involved in that. My job is just to make sure that you're raising everything compliantly. But it's just interesting to see that dynamic between the literally two spectrums of the situation.
And they could be right. I guess that's what I'm saying. They could be right. Like back when, if you bought a deal in 2019 and then COVID hit, I was like, oh, you're fucked. Like you are done. Like you're never going to be working in this ever again. And then all of a sudden, those people who bought in 2019, they sold in 2021. They each walked off with a couple $1 million from those.
And they didn't even have to wait the entire cycle. Their business plan called for a 3 to 5 to 7 year and a refinance. And then they were like, within 12 months, they're like, screw this. We've hit all our numbers. Let's get out. And they're out in 18 months. And they made a killing for themselves and for the investors. And so,
well, there's a difference if you're depending on the market versus buying the asset on its fundamentals. And so what we see though is people that bought predicated on those external things, they're the ones in trouble right now. They can't sell. They have to refinance at a higher rate. None of that was planned. Occupancies aren't going up. Rents aren't going up. So yeah, you're right. It can work, but it's also can turn on you in a second.
Yeah, but I'm still bitter because they're crying themselves to sleep with their millions of dollars that they made 18 months ago selling off all those other ones.
If they got out, there's a lot of people right now though that we all know about and are even in the news. They didn't get out.
And some we do know about.
Yes.
That we're not talking about necessarily, but we know about them.
Fair enough. You got anything else to add, AJ, or should we move on to the next one?
Just that's something everybody should look at and they need to think about, especially LP investors, is not the real estate deal. Ask the sponsor, how does your business work? Right? How many people do you have? How are you covering the bills? What does that look like? If we go into a downturn, does your company exist? And how does that work? And I think too often, too many people just look at line items within deals and look at something that was presented on a spreadsheet without looking behind and understanding the mechanics that go into it.
I would also, as one last point too, I also add, I hope that this changes a little bit with how investors are getting paid. We just kind of got that whole like, oh, it's got to be a 6 pref 70-30. And that kind of like, if you didn't see that, then investors are like, I'm out. Like, I'm not doing that. And I hope it kind of opens people's eyes to, okay, what's the real basis behind why that was occurring. And hopefully that changes a little bit too, because I don't think that aligns everybody in that case. All right. You're up, Mauricio. You ready for this?
Oh, Mauricio's up. I got to go grab something.
Go grab something.
Come back 25 minutes later. So I'm gonna lead off. What's that?
I really want to do this. Let's just jump to the top 10. That's my favorite part of the show.
Let's skip Mauricio and go right to the top 10.
Let's up the top 10. I actually want to see how Kyle does on the teleprompting. I thought I was going to give him some props on the teleprompting. I had some feedback on his last segment on teleprompting, but he actually did a really nice job of looking away and making it a little bit more.
So you don't want to just stare at it like this time?
No, I thought you did a very good job. I commend you on your teleprompting skills.
All right, thanks, man. So Mauricio, I'm going to lead in your segment by reading word for word. I'm going to leave out some details to protect the innocent or whatever they usually say, but maybe innocent. But I'm going to read word for word an email that I received, and then I'm just going to let you take it away based off of your thoughts and go into your segment. So this is me reading the email. Hi, Kyle. Wanted to ask you if you'd be interested in partnering with us to raise equity for a proven value-add multifamily deal in a high-growth Sunbelt market. Our fantastic new investment opportunity, name of the property, is a number of units property built in age, strategically located in the heart of X city. It goes on and talks about the deal and then ends off the email by saying, are you interested in partnering with us as a general partner to generate equity for this $10 million raise? Now, we've been super like protective of not trying to, bring people on just to raise equity. We've literally like we had a whole issue the one time where we were concerned that the optics would be bad, that someone was just raising equity, so we like parted ways with that person. And so we've been super careful about that. But then I get these emails from people that are just seem to be like throwing it out. They're like, hey, want to come on our deal and raise money for us? And so I wanted to throw that out to you and say, how are these people getting around this? Are they just doing something illegal, or is there ways that they're actually skirting this?
And I'm sure Mauricio is going to say this, but just to see this conversation real quick for anybody that's listening, when Kyle says raise equity, he's basically talking about raising capital for deals, bringing in passive investors for deals. And as Mauricio, as I'm sure is about to explain, it's illegal for people unless they are licensed to get paid to bring in, or to get paid based on how much equity or how much cash or capital they bring into a deal.
Yeah, you guys just want some free legal advice is what I'm really gathering from this, right? Is that how it works? No, I mean, look, this is a pattern, and it's a trend that we've been seeing over the last, it's actually been a while now, probably a good couple of years now. But as it's getting harder and harder to raise capital, that's really what's going on. It's just harder and harder to raise capital. And so people have done a couple of things. One is what you're just describing, which is that they're trying to partner with people who can potentially bring in some capital to help them with the raise. So that's what we call kind of co-GPing. That's kind of what people have been doing first. But an interesting phenomenon has been happening over the last 12 months, which is that co-GP model, which is people being brought on to the co-sponsor to purely to raise capital, which is, to your point, Jay, and I'll get to it in a second, is completely illegal. But it kind of starting to get out of hand. And I think people are recognizing that it's getting out of hand, because literally I've seen deals where you'll have 12 to 15 co-sponsors on a deal, and there's no way you need anywhere near that amount of people to actually run the deal. There's 1 or 2 or 10 or 20 that are there just to bring in the capital. And that's the issue. But what's interesting is, because I think it's become kind of obvious that this is something that's not supposed to happen, people have been moving to a different model, which is kind of this fund of funds model, where people are just starting to raise money into their own funds to then go place the capital to different sponsors. So I think the markets acknowledge that the way they're doing it isn't really quite the right way. So I'm starting to see the pivot to a different model, which also has its own issues, which we'll get into in a different episode. But yeah, look, at the end of the day, what people need to understand is that when you raise capital for other people, right? If you get brought in as a co-GP and you're raising money for that deal, you need a license. The general rule is you will need a broker-dealer's license. Anytime you raise money for somebody else, you need a broker-dealer's license, just like you need a legal license to practice law or a medical license to practice medicine. You need a license, or you need an exemption. And the exemption is what most normal sponsors rely on. And I think a lot of them relying on it without knowing it, just because it's like, well, this is how we've always done it. This is how everybody does it. So I know I don't need a license, but they don't quite understand why. But the reason you have the exemption is because you're not primarily getting compensated for raising the capital. That's the key. If your primary role is to bring in the capital, you need a license. You have to be doing other things, real things, to be a real co-sponsor. You have to be helping with the underwriting, with the due diligence, with the acquisitions, with the asset management is the big one. So once the deal closes and you've raised all the money, now what are you doing? Are you involved in the asset management? Are you involved in the meetings? Are you involved in the investor relations? Are you involved in everything that happens once that deal closes? Because as you guys know, if you look at a timeline, let's say your average deal is 5 to 7 years, you only spend maybe a few months raising the capital, and then you spend, the vast majority of your time asset managing. And so you need to be spending most of your time on asset managing. And if you're just raising capital and then going home and just collecting a check, you're not going to fit into the exemption. So the key to all this is I've ultimately boiled it down to 3 things, which is 1, you cannot receive what's called transaction-based compensation. By the way, that email in and of itself, I don't think was the end of the world. I've seen way worse. The ones that are worse are when they say, hey, Kyle, I know you're raising money for your fund. Let's just say it's Mauricio. Kyle, I know you're raising for the fund. I can probably bring in 500 grand into your fund, but I want 5% of the GP for that 500 grand. And if I bring in $1 million, Kyle, I want 10% of your GP. That is transaction based, right? Because the way a true joint venture or true co-GP model works, even if you bring in $0, you're getting paid. Why? Because you're not getting paid to raise the money. You're getting paid to do the work. So you're bringing in Mauricio because let's say you guys are buying a property in California. Well, I live in California. I'm boots on the ground. I know I have people here. I have relationships with brokers and lenders and all that stuff. And if we need to go visit the property, Mauricio's going to go visit the property. I'm boots on the ground. I'm doing real work, right? And so that's what a true co-GP does. So you don't want to get paid transaction-based compensation. You want to primarily be doing what's called substantial duties, which is really just being a real freaking operator. Like if you're not doing the real work, then forget it. You've got to be doing substantial duties, and the majority of your time, your primary role needs to be doing those substantial duties.
So you're saying like in the course of this, like, so this email that I'm talking about, like they would bring in the person on the GP and they would just make sure that they're doing substantial duties as well. It's still okay for them to solicit it.
Yeah, I think that particular email. Yeah, so that particular email, I will give them the benefit of the doubt, because if I say, Kyle, my name is Mauricio, I live in California, I've got a lot of experience. If you buy something here, I know you're looking to buy something here in San Diego or LA or whatever. I know the market really well. I've got contacts. I've got relationships. I can help out finding the deal, managing the deal. If I'm really doing real work, then this is just a joint venture. This is a business relationship that you and I are going to get into, and there's no problem with that. The problem arises just when, hey, I've got money that I can bring into your deal, and in exchange for me bringing in the deal, I want to get a cut of the deal, and that's primarily what I want to do. I just want to raise the money, or not. When I say raise the money, bring in the investors.
Because he's saying the other way around. He literally says, hey, would you be willing to bring in some money for a cut of the GP?
Correct. And that has to be incidental. Like the bringing in can be the gravy, the icing on the cake. Like, hey, I can help you manage this deal. I've got a lot of experience, Kyle. I can help you on this deal, man. I know, like, look at this. I mean, look at AJ is a great example. Like, you know, if you guys suddenly decided to be like, you know what, I want to expand to self-storage. Like I really want to go to self-storage. I know a little bit about self-storage, but I'm not the master at it. So why not go to the master, AJ? And I can go to the master and be like, AJ, would you like to partner with me? Because I have a lot of experience in business, and I've got a bunch of different deals I'm looking at, but I really need somebody with a lot of experience in self-storage. So AJ, will you partner with me and help me take down this property? Because I kind of know what I'm doing, but not really. Will you help me? And we partner together, and yeah, he may bring in some money as part of the deal, but his primary role is going to be to help me acquire, underwrite, asset manage.
You keep saying that though, but like the last line of this email literally says, are you interested in partnering with us as a general partner to generate equity for the $10 million raise? So it's literally saying, do you want to partner with us to raise money?
If that's what the thing is. So if that's the intent, if the intent is, if a precondition for us partnering together is that you can bring in a bunch of money, then that means your primary role is not going to be the actual work. It's going to be bringing in the money, and that's going to be licensed activity, a broker-dealer activity. And so you need a license, or you need to find an exemption, and you're not going to find the exemption because you're not doing substantial work.
I mean, is it safe to say that regardless of that email, everything could be done legally? Maybe somebody calls that person and says, okay, I want to bring $10 million. And they say, great, but you have to do all the work too, because I need you to justify. And then it's completely legal. But let me ask you a question. If that was your client sending that email, even though it's potentially up and up, even though potentially what happens after that email is sent is 100% legal, would you recommend they probably not send that email in that form?
Yeah, no, I would definitely not recommend in doing that, right? Because it doesn't have the good optics.
What Jay is getting at is could you draft a proper email to solicit people to raise money for a deal that, you know, someone may or may not want to use?
No, I mean, because people ask me all the time is like, if I'm looking for joint venture partners, that's really what it is. When you're partnering with somebody as a co-GP, you're basically a joint venture. Think of it that way. You're starting a business with those people. So there's nothing wrong with me going online and social media and say, hey, look, I'm looking for joint venture partners. If that's truly what you're doing, right? The number one thing if you leave nothing else from this little spiel, is just recognize that those emails that are going back and forth between everyone. That email, and then Kyle, you respond. Oh man, how much can you? Hey, wait, you can bring in some. How much can you bring? Oh, I can bring in $500,000. Oh, how? I'll give you 5%. No, I want 7. Like all of those emails that are going back and forth, those negotiations, none of that is privileged. So if this ever becomes an issue and a regulator is breathing down your back, they're going to request all of your correspondence, all of your emails, all of your texts, all of your everything. And it's going to be hard for you to say, no. I was brought in to do whatever. And then you look at the docs, you look at the emails, and clearly there's a negotiation going back and forth about this is how much I can bring. This is how much I want to give. And that email chain, that evidence, so to speak, is not going to be in your favor.
So exchange capital for exchange for equity in the terms of GP is
transaction based. Yeah, that's called transaction based compensation. Anytime you get paid based on whether the transaction happens, meaning I bring in a certain amount of money, you give me a certain amount of percentage. If I don't bring any money, you're not going to give me any percentage. Or if I bring in more money, you're going to be more percentage. That transaction based is the hallmark of broker dealer activity. And that requires a broker dealer license, which nobody has. I mean, that's not something that anybody wants to do.
Are there any legal ways that you're seeing people get around this? So like I've heard people say like, okay, I'm signing an advertising contract with X person and they're getting paid X amount. Or there's the other one you talked about, like the fund, where they give a discount from the fund or something like that. Is there any legal ways to do this?
If you do a fund of funds properly, that's the way to go. Just like the other stuff, the SEC or the regulators don't care how you structure it. They're going to look right through it. They're going to be like, are you getting compensated to bring in capital? Yes or no. They don't care if you structure it as a marketing agreement or a consulting. Those are actually red flags. It's like when you do your tax, like the tax IRS has all these like red flags, all those schemes that people do. And those are like on their red flag list. Those are on the SEC's red flag. If you have a consulting agreement or a marketing agreement, you better have that dialed in, documented, and then you have to prove that you actually did whatever you're saying you did, because they're not idiots. As much as I don't like the SEC and give all the regulators a hard time, they're not morons, right? They understand the deal. So the best way to do it, I think, is either be a legitimate co-GP, come into the partnership, add value to the partnership, whether it's acquisitions, due diligence, asset management, investor relations, whatever it is, add value. So your primary role is doing the thing, or set up your own fund. If you're good at capital raising, create your own fund, do a proper offering, PPM, all the legal stuff, and then be like, hey, I've got a bunch of money in my fund. AJ, I love your self-storage. Let me give you $500,000. Jay, Kyle, your apartment complex is awesome. I'm gonna give you $1 million because I like it more than AJ. So I only gave AJ 500. I'm gonna give you $1 million. Mauricio, I love your deal. And then you start allocating capital, and now you're getting compensated not for raising the capital. You're getting compensated for basically allocating that capital and doing the due diligence on all these projects and all these sponsors.
Mauricio, do you know anybody who sets up funds like that we could talk to?
There's an amazing firm called Premier Law Group. I think if you just Google them, and Mauricio Raoul is, I think they're
no. You don't want to talk to the Mauricio guy. There's a woman named Bethany LaFlamme.
Oh, yeah, she's much better.
Yeah, Bethany LaFlamme is even better. You're right. I take that back. Bethany LaFlamme is your go-to gal at Premier Law Group.
Which, by the way, she's part of Ashley's pack.
Dog pack.
Dude, we're all going to go to Coeur d'Alene. Are you going to be in Coeur d'Alene?
If Ashley's there, I'm not. We got kids, man.
Oh, that's right. Okay. No, I'll be in Coeur d'Alene.
Hey, Mauricio, can I ask, what is the reasoning behind this? So we're talking a lot about what it is, like, why do they, first of all, why do they care? Is this simply one of the things that's like to protect the licensing parts? Or is it, no, there's actually legitimate reasons why they would be concerned about this, or why they don't like this kind of activity?
They want to protect the consumer, right? They don't want AJ going out and talking to all these mom and pop investors and convincing them to bring in money to go then just give it to Kyle. Like that's facilitating a transaction of securities, and it's regulated. That's just a regulated business. So they want you to have a license for it. So they have spoken. And now here's the issue. And I'll just, I don't know if this is a little too, so they are talking about this idea that if you are at a certain level, there's actually a rule that's already passed the SEC that says that will allow you to actually act and do what you're doing and get a commission out of it. Because if you want to be a true broker dealer, which is what this is, here's what happens. The SEC said, look, you need to have a broker dealer license. great. The problem is if I go get a broker dealer, they don't want to get out of bed for less than 25, 50, $100 million. So there's a gap in the market where like, what if I only want to raise 2 or 3 million? I can't go to a real broker dealer to get them to raise money for me because they won't get out of bed and share their contacts with me unless I'm raising 50 million. So there's actually a rule that passed. I shouldn't say it passed. It was a proposed rule in the SEC that said, hey, we're going to allow you to get a commission to do exactly what we're all trying to do. It's going to allow you to bring in investors, co-GP, and do all this stuff. But that happened, unfortunately, right when the new administration came in and the new commissioner came in, and that's just been tabled. I think one day it will pass. I think we're not that far away from a new rule, probably in the next 3 to 5 years, where you will be allowed to make introductions or be a co-GP, or actually you don't even have to be a co-GP. You're going to be able to I'm going to be able to say, AJ, I've got an investor. I want to refer him to you. He invests 100 grand in AJ and I'm going to get paid 5% or 10%. I think we're not too far away from that because the rule's already there. There's just a lot of politics that hasn't happened yet, but I think
the rule, in my opinion, is too restrictive, but it on its surface, like I get it. Like it makes sense. Like you want somebody who's raising money for the deal to understand how the deal works and understand that what they're selling is actually a good deal. Like you don't want somebody just coming off of, who's really good at social media or something, and they are raising money for this, apartment complex. They don't even know how an apartment complex syndication works, but they're going off to because they're really good at marketing. They could say, hey, I'm going to raise this amount of money. This is a great deal, but they don't really get that it's a great deal. So the government wants you to take classes and courses and make sure you understand what the risks are and make sure you're disclosing those to your investors. And they want to regulate. Or be involved in the deal so that you actually know what's like. If you're actually involved instrumentally in the deal, that means you probably know what's going on and you get it. You could say, hey, this is a great deal.
Yeah.
Fair enough. Jay, and any last words?
No, I will point out that at the end of that email that you were reading, there's a link to click if you're interested. And that link takes you to basically a form to fill out. And the one substantial question on that form is how much money can you raise?
Right. And that's the problem, right? And again, that's the part that drives me nuts because, I used to be a former litigator. So I know about all the evidence rules and all that stuff and privilege and all that stuff. But, that is all non-privileged. So if you ever get into an issue, meaning investors lose their money in your deal, which is starting to happen more and more, I think a lot of this stuff's going to come out. When investors lose their deal, you may have done everything perfectly. It may not have been your fault. The market changed. You have zero fault in the fact that your investors lost money, but because you brought in an unlicensed broker, now you're going to get nailed for that, even though everything else was good. And I think you're going to start seeing that.
Alrighty. Can we move on to the top 10?
We're still waiting for Mauricio to do a top 10.
Still waiting, but I every month or every week I always prepare one just in case Mauricio's not ready, and it doesn't seem like he is. So
I did. If you guys missed the episode, go back and watch all the other episodes until you find it about the top 10 worst top 10 Kyle's ever done. I started doing that, and then I just gave up because it was just too lame.
Well, I'll try and top that. I'll try and put this one on the list. So in the spirit of AJ last week, where the reason we couldn't record is AJ couldn't get on his private plane, I thought I would do a top 10 list of private planes. So this is the top 10 most expensive private planes. And actually it's top 11 because I'm going to start with number 11 because 11 is Jay-Z, and I just wanted to throw Jay-Z on the list.
Oh, you mean people? I got to name names?
So, we're naming names for sure.
Oh, I thought it was like the Boeing 737 or the Citation 10.
It's going to be both. So,
okay.
so number 11 is Jay-Z. He has the Bombardier Challenger 850, and that's 40 million. So 40 million doesn't get you on the top 10 list. Number 10 is Bill Gates. He has the Bombardier 8000. That's 66 million. And number nine, actually, this is a big list here. We have Elon Musk, Jeff Bezos, Sergey Brin, Larry Page. They all have the Gulfstream G650, and that's 70 million. The next, it's I have no idea who this guy is. Mukesh Ambani, Boeing Business Jet 2, 73 million. The next one's funny. Richard Branson and Oprah. They have the Gulfstream GH50. That's 75 million.
Do they share one or they each have one?
No, they each have one. Number 6. Everyone's favorite talking head, Donald Trump, Boeing 757. So it must be converted. Apparently that's worth 100 million. And then there's a bit of a jump. Kim Kardashian, Gulfstream, another G650, but it must be custom ER. That's 150 million. Roman Abramovich, another 757, 170 million. The Sultan of Brunei has a converted 7047. That's 230 million. Joseph Lau, a converted 747 8 VIP, 367 million. And then the most expensive private jet is a Russian guy, I'm assuming he's an oligarch, 400 million.
So the reason I know that is a wrong list is because Uncle G, Grant Cardone, has a Gulfstream G650, which I know there's several of those on your list.
Yeah.
And it's on the internet, so it's obviously true. $61 million. So doesn't that not put him in the top 10 with $61 million?
Well, so number 10 was 66 million. So he wouldn't have been in the top 10.
But he might be in the top 20. All right. All right. Sorry,
he might have snuck above Jay-Z, but I wanted to say Jay-Z. So.
Where does AJ Osborne rank on that list?
Yeah, AJ, where are you? Like number 7, 8, somewhere around there?
Yeah, right. Those are unfathomable numbers.
Well, but it is interesting when you talk about that Gulfstream, Mauricio, that like Kim Kardashian has a Gulfstream G650 ER and it's 150 million.
Yeah, so does Grant. Yeah, it's probably used. I mean, obviously, look. First of all, I watch the jet business on TikTok, and that's a great channel that you guys should watch. I learn a lot about private jets on the jet business. It's a great. He's in London. And yeah, the age of the plane matters, right? The engines they're probably Rolls-Royce engines, but like how old are the engines? You know, what the interior looks like.
It's crazy to me that like Elon Musk and Kim Kardashian have the same basic plane, but one of them's 70 million and one's 150 million. Like,
so she has the ER. She has the ER, which has better sound system.
Well, no, the Elon Musk has the ER too.
I get upset. I actually get upset because, you know, I look at what the plane, AJ, you can confirm this, but the cost of the plane is up there, but it's not crazy. You can get a private plane, AJ, correct me if I'm wrong, for like 3, 4, like 2, 5, like you can get something in that. So it's not crazy, right? But it's the freaking jet fuel, the hangars, the maintenance, like the hour, even if you own the plane.
The cost associated with the
like
pilots.
Without you giving too much detail, give me a ballpark. When you take your plane, what is the hourly cost to run that thing? When you fly from point A from point B, what does that run you? Like $1,800 or $2,000 or an hour? $3,000 an hour. Yeah.
Because, well, it depends on how you calculate cost. You have, first of all, if you have pilots, you have to pay for the pilots, you have to pay for their stay, you have to pay for the hangar and the gas. So it's not just like it's
there's a means for them just to show up, right?
Yeah. You gotta, I mean, it's
I think most people, I think a private plane in and of itself is not cost prohibitive. It's the freaking just flying itself. Even if you own the plane, it's still going to cost you.
Most people buy planes just because of tax benefits. That's it.
Mauricio, here's a would you rather. Would you rather be gifted a private plane or be able to fly first class the rest of your life for free?
I would rather be gifted the operational cost of a plane, and then me have to go buy the plane.
Don't change the question. Change the question is: would you rather be gifted a private plane? You can't turn around and sell it. Be gifted a private plane or fly first class for free the rest of your life.
Yeah, right now I do the first class because I can't afford the freaking $3,000 an hour. So I want to fly to Dallas. That's 3 hours there, 3 hours back. Plus the plane's got to stay there overnight. It's going to cost me still 20, 30 grand.
That's variable cost, not including fixed cost when it's sitting on the ground and you're not flying it.
Right. So it's like, yeah. So I'd rather take the first class because I'm too poor.
And the good planes, I think you have to use like the 93. You can't use the 87.
That's
gas.
right. And diesel. AJ's plane is diesel, I think.
I don't know. His plane can't even reach overseas or make it to Hawaii. So apparently he's got one of the.
He can't even make it to Newport Beach. Apparently,
not last week.
Apparently, the 747s can't either in first class. That doesn't work either.
All right, let's. We good? Move on to plugs here. Jay, you got something for us?
We're not doing would you rather?
I had another one, but I feel like I snuck one in there. Do you want me to do another one? All right, I got another one. All right. Would you rather? So this is in spirit of the Super Bowl. I don't know. I assume everyone watched the Super Bowl. Most watched television event I heard since the first moon landing. So which I always thought, I think it probably beat the World Cup. So I was going to throw out there, would you rather have tickets, or let's say the whole weekend gifted to you of the Super Bowl, the World Cup, or the Masters? And you could substitute the waste management in for the Masters if you're more into that. Jay, what are you picking?
Is Masters the sailing one?
That's the one where Messi scores 5 goals.
Let's be clear. I loved the football game we went to together, but it was more the company than it was the game. Soccer doesn't do it for me. So I wouldn't be interested in that.
But like World Cup finals, we're talking about like
Kentucky Derby.
Kentucky Derby. Sure. We'll throw in Kentucky Derby there too. Is that your pick?
I've been to the Kentucky Derby. I would do the one that I haven't been to that seems interesting. I think Masters. I've never been to a professional golf match.
It's a tough ticket. And that's why I didn't put Kentucky Derby in there, because like we could just go buy tickets and we could go. But like if you want to go to the Super Bowl, like minimum $6,000 for nosebleeds.
This is like tickets for life, right?
No, this is one weekend. One
By
weekend.
the way, I heard the Super Bowl suites were $2.5 million.
Yeah. I mean, you get how many seats in there? 30 seats or something, but yeah.
Do I get to go to the suites though, or are you putting me up on the nosebleed seats?
No, we'll just say a decent ticket, not nosebleeds, a decent ticket.
Well, considering I didn't even watch the Super Bowl on TV, I couldn't give a rat's ass about the Super Bowl. I'm going to go with the World Cup, just because. Look, I grew up in South America. I grew up in England, which are two crazy soccer places. So yeah, the World Cup would be for me.
I think the World Cup, because I could have a higher resale value on the tickets.
Don't skirt the issue. Which one would you rather go to and attend? If I'm giving it to you, I'm
Super
saying
Bowl.
Super Bowl.
Well, we have one of each. Okay, Kyle, you're the tiebreaker.
I'm going Super Bowl for sure too. I've become a big football fan, especially since I moved to Philadelphia and I can
America.
So yeah.
When are we going to the Kentucky Derby? I thought we were going to do a podcast from one of the suites at Kentucky Derby. I thought Jay was going to set that up, and nothing. It's all talk.
Kentucky Derby hasn't happened yet, has it?
It's in May, right?
Yeah, I've got a couple of months.
Dude, my daughter's birthday is right around there, so you got to coordinate it ahead of time.
I think my daughter will be there.
When is the Kentucky Derby anyway? What week is it?
It's usually like the first weekend in May.
Okay, good, because I got Cigar Fest the third weekend.
Dude, wait! You have a cigar fest and I don't know about it?
Wait, are you cigar guy, Mauricio?
I can definitely smoke some. I smoked some cigar in Maui when I was out there.
You should come up for Cigar Fest then. It's a great time.
Let's do it.
Pencil it in. May 17th, I think it's something that weekend. Yeah.
All right.
Jay, you got anything to plug?
Conference Connect. Everybody go to conferenceconnect.com. Find your next conference. If you're a conference speaker, you want to speak at conferences, go fill out a speaker profile so event organizers can find you and hire you. If you have events, if you have conferences that you organize, go check it out, because we'll help you get your tickets sold. So conferenceconnect.com. There you go.
Yeah, Mauricio, you have a speaker profile on there yet? You're a pretty prolific speaker.
I was making notes. Conferenceconnect.com. Are you kidding me? I'm like the premier syndication attorney.
What was that name of that again? I missed it.
Conferenceconnect.com.
That's right.
AJ, you got a profile set up? Get assistant number 3 to go set up a profile for you on conferenceconnect.com. I'll give you a 5-star review too if you go do that. I've heard you speak.
Wait! You can get star reviews?
Yeah, you can review speakers, review conferences.
I would crush that. Are you kidding me?
I don't think we've rolled out the reviews yet, though.
Oh, that would be game over. If I put my profile in there and there was reviews in there, it'd be all over.
Sure you can, Jay. Star reviews. But we'll go double check.
Let's move on from your plugs.
All right. Well, let's go on to your plug then, Mauricio. What do you want to plug? Conference Connect. Wow, that's a great plug. Thanks, man.
I'm going to plug legalstrategiesforeveryone.com. The new book coming out in 2 weeks. We talk about estate planning, asset protection, all kinds of stuff. So if you're looking for legal strategies for everyone, just go to the website.
You're going back to your roots, asset protection, right?
Going back to the roots. I'm a former retired recovering asset protection attorney. AJ, what wine are you plugging?
Our newsletter. Go check it out. Got a newsletter that comes out about every week, full of things we're seeing in the market, data, all sorts of good stuff.
And AJ will put a link to that in his Conference Connect profile if you want to go check AJ out and get a link to his.
I'm getting on right now.
Awesome, man.
Yeah, I know. I'm going to check it out right now. Conferenceconnect.com.
Well, I feel like I've already plugged my wife enough with the Conference Connect, so we don't have to do any more. And I don't know about you guys, but my drink is gone. It's nice to have us all back together. As Jay said, this is one of the highlights of my week. Us all being together. Love you guys. But I'm gonna go hit the head. I think we're all back together next week, right? So
We are.
I will see you all next Tuesday.
See you.